Hello and welcome to the latest Insights Live, our 2026 outlook for the markets and economy. I'm Susie Allen, Vice President of Insights from Fidelity Wealth Management. Thank you for joining us and submitting your questions. Well, the markets have been a wild ride in 2025, leaving many of us to wonder what's in store for the coming year. We'll be doing a deep dive on the factors influencing today's markets, what you might expect in the year ahead, and wealth planning strategies to help you make the most of opportunities. Today, I'm joined by our panelists, Lars Schuster, Institutional Portfolio Manager with Fidelity Strategic Advisors, the investment management firm for many of our clients who have managed accounts, and Lauren Fabry, a Vice President and Wealth Planner with Fidelity based in Texas. Before we get going, I'd like to let you know that Fidelity does not give tax or legal advice, and nothing we discuss today should be interpreted as tax or legal advice. The information we are providing is going to be general in nature and it may not apply to your situation. So if you do have legal or tax questions about your specific situation, we encourage you to talk to your attorney or tax professional. So Lauren, welcome. I want to start with you since you work with clients every day. What are the questions you're hearing most frequently right now?
Thank you, Susie. First off, I'm super excited to be here with you and Lars today on Insights Live. To address your question, while markets have been solid for 2025, there's still plenty of uncertainty prompting clients to question whether they need to be making any changes to their investment strategy and/or financial plan. So some of these questions I've been getting are, is it safe to invest with markets at all-time highs? Clients worry about buying at the peak and often ask if they should wait for a correction or just stick with their plan. We always encourage clients to try to not time the market. Time in the market is always more important than timing the market. Nobody has that crystal ball to know when the markets are going to turn either in an upward or downward movement. Another question that we get is, am I still on track for retirement? Market highs and economic uncertainty is prompting clients to revisit their long-term goals, which can be done by reviewing their financial plan. And along with that, this can also be done by examining their investment strategy to make sure they have the most appropriate mix between stocks, bonds, and cash. Another question is, how do taxes factor into my strategy now? Year-end tax planning, tax loss harvesting, and capital gains management are always top of mind for clients. And then, of course, we're hearing a lot about questions regarding artificial intelligence, AI, and investing in precious metals. And most of these questions we're going to address throughout the duration of this webinar.
All right, well, thank you for that overview. So let's start with the big picture. Lars, welcome back as always. And there have been a lot of mixed signals from the US economy. Growth has been steady, but there seem to be areas of softness like new job hiring. So can you explain which economic signals really matter and whether we're looking at a recession?
Yeah, thanks, Susie. Thanks for having me. And I'm glad that everyone could spend a little time with us today. Look, to answer your question, totally true. There are some slowing areas of the economy, but largely speaking, the US remains in expansion in our view, and we don't see an imminent recession. So maybe what are the things that are driving that view? It really comes down to things like corporate profits, the willingness from banks to lend to businesses, a low firing trend, and resilient consumer spending. I'm going to like to bring up and show a few of these on screen. It's actually a visual we have in our Strategic Advisors quarterly market perspective. So if you'd like to examine that in greater detail, just please connect with your Fidelity representative. But there's four boxes on this visual. And on the top left, this is highlighting corporate profits over the last 20 years or corporate earnings. And on the far right of that little graphic in that box, you can really see that corporate profits have remained strong in 2025, growing double digits. If you shift over to the top right, that's a measure of banks' willingness to lend. When that line is moving down, it means banks are more willing to lend. They're not tightening up the purse strings, if you will. And so we've actually been seeing that banks are more willing to lend, and that could be helpful for companies should they want to or seek to invest in their businesses. Now, companies aren't adding to staff in big numbers, and that's that bottom right visual that I'm highlighting a little bit. Job hiring has been pretty muted. That is what you reflected on, Susie, in your question. but they aren't laying off big numbers of employees either. And that's what that bottom right visual is highlighting. It's weekly jobless claims, and they remain near historical lows. So I kind of refer to this whole dynamic as low hiring, low firing. And broadly speaking, those who have kept their jobs have seen some positive wage growth near 4%. That's above pre-pandemic levels. So that's really helping fuel consumer spending. And that is the largest component of US economic growth. Consumer spending has also been further supported this year and last year by a wealth effect, given these higher stock market returns that we've seen. That's really boosted some investment portfolios, particularly for retirees. Now, again, there are some areas of the economy that are challenged. When you look at lower income households, they're feeling the pinch from these stubbornly high prices for everyday goods and services. And there are some industries like housing that remain weak. But I think we just need to take this in context. At a roughly $30 trillion economy, the US is very large, it's very diversified. So while there are some areas of softness that really bear close watching, on balance, the economy continues to grow.
Super helpful context there. Let's talk a bit more about other contributing factors. It's been a big year for policy changes with the new tax bill and lots of tariff announcements. So, what potential policy changes for next year are you keeping an eye on that could have an impact on clients?
Yeah, it's almost actually felt like an exhausting year for maybe some of us with the headlines around policies. But you're right, there have been a lot of different changes over this past year related to tariffs, immigration, tax and spending changes, deregulatory efforts. And I think each of these really impact us all a little bit differently. But collectively, I think it's important just for us to assess how they impact the pace of economic growth and the direction of corporate earnings. And from this lens, if we look at tariffs and immigration, they may still blunt growth and weigh on prices for many goods and services. In fact, in recent months, we've actually seen warmer prices coming from goods like clothing, auto parts, that have actually experienced higher tariffs. However, the flip side of that is that there are various deregulatory efforts that really could stimulate bank lending. Tax incentives for many households and businesses could support spending and growth in the future. So I think if we're just thinking about the near term here, various policy measures could be slightly tilted in favor of an economic boost. And that's because maybe some of the worst of the news regarding tariffs could be behind us for the moment. We've already heard the big tariff numbers way back in April. And since that time, many tariffs have actually been adjusted downward. And also, it kind of appears to me that the administration is actually willing to negotiate or shift some tariffs further if it actually hurts consumers, or at least the affordability of most US consumers. At the same time, you brought it up, the tax and spending bill that was passed this summer, that could have a positive economic impact for the economy in early 2026. Now, that legislation just simply made many tax cuts implemented in the 2017 bill permanent, but there were some additional stimulative provisions that were either extended or enhanced. So, for example, I'll give you one. American households are expected to receive sizable refunds in early 2026. There have been estimates recently that have focused on somewhere in the neighborhood of like $150 billion of refunds. Now, that amounts to about 0.5% of US GDP. It's by no means this bazooka of stimulus, but consumers usually spend money that they receive via refunds, and that could actually help offset the higher inflation that has somewhat pestered consumer spending here in 2025.
Well, you had mentioned the new tax bill, and so I want to follow up there for a second. So that was a big policy change this year. And so, Lauren, is there anything clients may need to consider for the remainder of this year?
Yeah, absolutely, Susie. So as noted, the new bill was passed on July 4th of 2025, and there were certain impacts that went into effect immediately, and there's some that we will see go into play in 2026. So there are three areas that I want to touch on regarding the tax bill. The first one is charitable giving. This is one of the items that will go into effect in 2026. And just to touch on some of those numbers, for those who do not itemize their taxes, they will get an above the line deduction for cash contributions, $1,000 for those who file single, and $2,000 for married filing jointly. Now, those who do itemize their taxes, charitable contributions are deductible only to the extent that they exceed 0.5% of their adjusted gross income. So for example, if one's adjusted gross income is $500,000, the first $2,500 is not deductible and only amounts above will qualify. So again, what we're seeing is some clients are trying to accelerate their charitable giving in 2025 due to these new deduction limits that will be going into effect in January of 2026. The second area I want to touch on is the state and local tax deduction, also known as SALT. Prior to the tax bill, it was capped at $10,000 for married filing jointly, and it's now been extended to $40,000 for married filing jointly if they are below the phase out of $500,000 for their modified adjusted gross income. Now, this did go into effect immediately. So one strategy some clients are looking to implement is considering prepaying property or state taxes before year end to take advantage of that increase in the cap. And then the third area is the senior tax deduction. And for those who are over age 65, they will receive $6,000 deduction if their modified adjusted gross income is below $75,000 for single filers and $150,000 for those who file married filing jointly. We're seeing clients manage this in two ways. This also did go into effect immediately. So I have some clients who are trying to limit their income this year to ensure they qualify, and some are trying to take more income this year to ensure that they'll qualify for the deduction in future years.
Well, those are very timely considerations, Lauren. Thank you. So Lars, last year at this time, we asked whether the bull market could continue. And we did have a few pullbacks last year, but they were followed by new highs. So here I am asking again, given the long period of positive returns, can this keep going?
Well, you're right. We were sitting in the same place last year, and it felt just as cold to me as we got close to the end of the year and the holiday season. But, one of the things we talked about last year at this time, Susie, was the conditions that were present that actually could potentially help support stock markets in 25, such as positive economic growth, growing corporate earnings, lower interest rates from the Federal Reserve. Many of those same conditions actually remain in place today. We've already talked before about how the U.S. remains in this economic expansion, as well as the potential tax incentive boost for the economy. And as I noted earlier, corporate profits are projected to grow double digits in 2025, and the outlook actually remains pretty positive for 2026. On top of that, the Federal Reserve, the central bank here in the U.S., has resumed an interest rate cutting cycle in recent months. In fact, just yesterday, they cut their key short-term overnight lending rate by another 25 basis points, or 0.25%. So those lower rates could potentially have a positive influence on economic growth. One item that we haven't talked about is the significant spending in support of artificial intelligence, or AI. I have a visual up here just to kind of try to put it in context a little bit. It's showing recent business spending, its impact to GDP growth. And just over the last year or two, you see that blue component of that mountain chart has really spiked significantly upward over the last couple of years. And much of that spending from businesses is all in regards to building out new data centers, and which is really the necessary infrastructure to support the adoption, the application of artificial intelligence across a wide range of industries. And we're talking about hundreds of billions of dollars being spent this year. That's more than 1% of GDP. And that is actually projected to continue into next year and potentially for several years in the future. And those dollars go to more than just semiconductor chips. They also go to entities and workers that build these myriad of data centers, install cooling units, supply energy needs, so on and so forth. So there are some positive conditions in place that could potentially continue to support US stocks. However, and I don't want to be this two-sided person here, but I do think we do need to point out that much of this is well known by the markets. And so I'm going to bring up another visual here, if we could. It's something that's reflecting something called valuations. It's the prices that our investors are willing to pay for future earnings. The visual's got a number of different lines on it. The one that's most important is that top green line on the slide. That's the squiggly one. And it's showing on the far right how it's inflected upward over the last year or two. It's showing essentially that US stocks have grown more expensive. In other words, they have high valuations. Now, high valuations by themselves doesn't necessarily mean a stock market decline is right around the corner. Historically, stock valuations aren't a great signal for near-term market returns. Rather, they need some kind of catalyst. So you have to ask yourself, what could that catalyst be? Perhaps it could be companies pulling back on AI spending. Maybe it's companies, laying off some employees over time. And that's why the investment team at Strategic Advisors and management of our client accounts, we're closely monitoring the health of companies in 26, as well as the jobs market. But as investors, I think we should just all be prepared that there could be moments of market choppiness or volatility, given these fairly high market expectations, not unlike what we saw earlier this year in 2025.
Thank you for those slides. They're super helpful, and every viewers, those are available for download should you want to spend some more time with them. And Lars, you also said it's cold up here, so we should have been doing this with Lauren in Texas. So Lauren, back to you. We talked a little bit about high valuations. So what do today's relatively high valuations mean for investor strategy? In other words, does it make sense to buy stocks when the market is so high?
Great question, Susie, and one that we've been getting for quite some time now, given the market's continued growth. So deciding to buy stocks when the market is high depends on several factors. It could be investment goals, time horizon, risk tolerance, which are all going to be very specific to each client situation. But with that, we do look at other key considerations. And the first one is valuation. And while it does matter, if the market in general is expensive, that doesn't necessarily mean that all stocks are equally overvalued. So there may be potential opportunities in undervalued sectors or companies. We also consider market timing, which I mentioned earlier. Historically, staying invested and focusing on long-term growth tends to outperform compared when one tries to predict short-term highs and lows. This is extremely difficult even for the professionals. One strategy to consider is dollar cost averaging. So if a client is hesitant to invest all at once, they can spread their purchases over time. The strategy may reduce the risk of buying at the peak. And a perfect example of this is investing in 401ks. Each paycheck you buy into your investments, and some periods the markets will be higher and other times the market will be lower. And then lastly, we look at diversification. So this could be buying across different asset classes, such as stocks versus bonds. We look at sector diversification and even different geographies, all with the intent to help reduce risk in the portfolio.
Right. Lauren, earlier Lars talked about potential volatility, and that's definitely on the minds of clients. So for those that you work with who may be worried about potential volatility or an economic slowdown, how does this affect allocation decisions for your clients?
Yeah, so when working with clients, I typically start by helping them build out their financial plan, as this really provides a framework for determining an asset allocation that aligns with their goals and objectives. Once the plan's constructed, there are two areas we focus on when determining an appropriate mix between stocks, bonds, and cash. The first one is going to be risk tolerance, and this is really understanding how much risk one is willing to take based on a specific goal. And within the financial plan, there could be multiple goals. It could be retirement, which could be 10 or 15 years out. We may have education goals for children, and maybe that's just a couple years out. And so it's normal for there to be multiple goals and multiple risk tolerances that are aligned with each one. The second area we look at is the time horizon and withdrawal amount. So the sooner a client needs to access the money and the greater the percentage withdrawn, the less risk the portfolio can withstand. And on the flip side, the more time one has before they start taking withdrawals and the lower the withdrawal rate, the portfolio may have a better chance of withstanding market fluctuations. When a client expresses concern about market volatility or potential slowdown, it's often signaling a lower risk tolerance level. So this could indicate that the client moves to a more conservative allocation by reducing stock exposure and increasing their fixed income. They could also consider tilting towards quality and defensive assets with equities that could be prioritizing companies with stable earnings and strong balance sheets. It could be defensive sectors such as healthcare, consumer staples, and utilities, which are generally considered to be less volatile during market slowdowns. And then again, diversification, which has been and will continue to creep into a lot of my answers. Diversification across geographies can help manage US specific economic risk. This year is exactly what we saw happen back in March, April of this year. US markets were down due to uncertainty of tariffs, and international markets were performing well. This helped with the overall performance of diversified portfolios. Other considerations that we would encourage clients to revisit is making sure that they're maintaining liquidity to ensure they have sufficient cash for near-term needs, which reduces the pressure to sell during market downturns. And then an interesting response based on my perspective as an advisor is there are behavioral considerations that come into play as well. Clients who panic when the market goes down may be more likely to sell their investments. So a more conservative allocation can help them stay invested for the long run.
Susie, if you don't mind, I just want to jump on Lauren's comment there because I couldn't agree more. That's probably one of the more important things that we all need to be very cognizant of, which is those behavioral considerations, because we're all human. We need to be aware that it's very challenging sometimes when investing toward a long-term goal, because there are those short-term moments where it's just uncomfortable to watch markets churn and sometimes see your account balances fall for a period of time. But this notion of this short-term volatility, Lauren and I have referenced it a couple times and a few answers. It is pretty normal. And in my view, it's the price or the experience investors need to simply endure in order to benefit from the long-term investment growth potential that stocks tend to provide over time. And I know I brought a lot of visuals here, but this is by far one of my favorites of all time in my time here at Fidelity. And if we could just bring it up, what it's showing, and we're just looking at US stock returns. And we talk a lot about US stock returns because it tends to be a larger part of a client's portfolio. It tends to be the growth driver of assets over a long period of time. But it's showing calendar year stock returns going back to 1980. And we can see that there are these intra-year pullbacks of 10% or more, which are very, very common. And that's actually reflected by those orange dots on the lower half of the visual that you see in front of you. What they're showing is the largest intra-year decline in each calendar year period for US stocks. And on average, if I went and averaged all those orange dots up, it shows an intra-year pullback, or from peak to trough, how stocks fall in each calendar year. On average, markets experience a pullback of about -13.5%. Now, the good news is that over time, stocks have demonstrated this ability for growth. In fact, we can see on this same visual that when you look at all those positive returns, the calendar year returns, it's the dark green columns, 37 of those 45 years were positive. That emphasizes this clear upward growth trajectory that stocks can potentially provide over time. So frankly, we don't need to go back all that far to see this dynamic. Just look at this year. Stocks have been up solidly, but at one point in April, they had fallen almost 20%. So it's this adage that stocks don't always go up, and past performance, we all know, doesn't guarantee future results. But over time, they have shown this potential for growth, and that's really important for those longer-term investment goals.
Oh, you're right. That is a great chart, and certainly great to reflect on history there too. You had mentioned technology earlier, so let's talk about that a bit. One area of the market that's been super strong, and now many investors may be looking at a portfolio, though, that's heavily weighted towards tech. So this brings up an important question for Lauren. How do you help your clients rebalance these concentrated positions?
Yeah, there's a saying out there that I like to remind my clients. Concentrated positions can potentially create wealth, and diversification is a strategy aimed at maintaining wealth. No doubt that concentrated positions can sometimes present challenges. However, the good news is that means the position has grown. The bad news is there could be a large taxable event that comes into play. I like to joke with my clients that it's easier to get my 5 and 7-year-old boys down to bed at night than it is to get clients to actually do something with these concentrated positions. But with that, there are some strategies that can be implemented to begin reducing the position while keeping taxes top of mind. The most common is to simply start unwinding the position and pay the capital gains tax. This is usually done over the course of many years to spread out the tax liability. And if someone has a low income year, this could present a potential opportunity. Another common approach is donating appreciated securities directly to a qualified charity or a donor advised fund. When done this way, the donor generally avoids realizing capital gains. The receiving organization, as a tax-exempt entity, does not incur tax liability upon the sale. So this strategy can provide potential tax benefits while supporting charitable goals. Another strategy are exchange funds can be used. And for those who are not familiar with how they work, it's a pooled investment where multiple investors contribute shares of appreciated securities. In return, each investor receives an interest in the diversified portfolio. After the required holding, which is usually around 7 years, the investor receives a pro rata share of the diversified portfolio, and ultimately taxes are deferred until the investor sells the shares from the fund. And then lastly, you could gift shares to family members who may be in lower tax brackets. As a reminder, when you gift shares, the cost basis stays with the shares.
Thank you, Lauren. And I'm going to flip it back to Lars here. Can you speak to this from the perspective of the client portfolios your team manages? How do you help maintain diversification when one area of the market outperforms?
Yeah, you're right. Because in the last few years, and it's no secret, there have been larger companies in certain sectors of the market here in the US that have grown significantly, and they do represent a larger part of the US stock market. I would say, though, there are still many other asset classes that have performed well this year, like non-US stocks. So it hasn't only been one thing that has really been helping drive diversified portfolios in 2025. However, to answer your question, in the portfolios we manage for our clients, we've really sought to manage this growing concentration risk. That's how I would illustrate this within US stocks in a few different ways. So let me provide three if I could. First, we've sought to really ensure we're investing beyond just US large growth stocks. I know that sounds obvious, but there are many other sectors out there like banks and industrials, as well as moving down in size of companies, so mid and small cap stocks. I think one common theme that we're hearing in recent quarters is corporate earnings forecasts is this expectation that growth will broaden out to other corners of the stock market. And should that occur, it may help reduce reliance on just a handful of companies to drive US stock market returns. And it could provide opportunities in other sectors that have really lagged in recent years. I think the second, and again, I want to bring that valuation visual back up again, because now I'm going to talk about the bottom half of that. The second way that we've really sought to reduce the concentration risk in US large growth stocks is by investing in those non-US markets. And that's that lower half of those squiggly lines that you see. That's showing developed international stocks. It's showing emerging market stocks and their valuation. And as you can see, they're a lot lower. So they're more relatively attractive than US stocks by themselves. And I think the other point that I'd point out about non-US stocks is they are made up of less growth tech companies. So you're diversifying your exposures beyond just tech. Finally, and the third one here is in well-diversified portfolios, it's important to remember that there's more than just stocks. Bonds and other diversifying assets like commodities and liquid alternatives have playing key roles as well.
All right. Well, you brought up the B word, so let's talk about bonds. Like stocks, bonds have performed strongly this year. Lauren, can you give us some context? How should clients think about the role of bonds in their portfolio?
Absolutely. So bonds are not quite as straightforward to understand as equities. So we sometimes see that clients are hesitant to add them to their portfolios. But that being said, they do play a very important role. And I want to talk about a couple different ways that it can benefit a portfolio. So the first is they provide stability. While stocks can be volatile, bonds can provide a more stable investment option. They can act as a cushion, reducing the ups and downs in the portfolio. Another benefit is income generation. With yields currently higher than they've been, bonds may offer a potential source of income, making them more attractive for retirees or income-focused investors. Here's diversification again. Bonds behave differently than stocks, especially treasuries or investment-grade credit. And when stocks decline, high-quality bonds can often hold value or even appreciate, acting as a hedge for the portfolio. Another way that clients introduce bonds into their portfolio is for capital preservation. High-quality bonds are designed to preserve your principal. And then lastly, we have inflation protection options. Certain bonds, like Treasury inflation protected securities, also known as TIPS, can help safeguard your purchasing power against inflation. And given what we went through the past couple of years, this was, definitely an attractive investment option for some clients.
Lauren, great overview. And Lars, over to you. So what's your expectation for bond performance next year? And what does that mean for how your team is positioning the bond portion of well-diversified portfolios?
Yeah, I don't have necessarily a crystal ball for the future. And I think you even referenced that earlier, Susie. But let's just reflect on 2025 for just a second, because it has been a solid year for bonds. If you're looking at this broad index of high quality bonds, they've actually risen roughly 7% in 2025. That's pretty solid for high quality bond returns. Now, some bonds like short-term, intermediate-term U.S. Treasuries, they rallied this year given that there was these expectations that the U.S. Federal Reserve would lower their lending rates, their short-term interest rates. And in fact, as I noted earlier, they have done that. They've actually lowered rates 3 times for a total of 75 basis points, or 0.75%. But a good portion of the index of this high quality bond returns was really driven by income. And that's what Lauren was just noting. So a year ago, we were in this same forum, and I noted that one of the benefits of the higher interest rate period that we all went through as investors and we had to endure back in 2022 was this boost that they would likely provide to future returns. And we're seeing that play out right now. So for example, at the beginning of 2025, the yield of the Bloomberg US Aggregate Bond Index was nearly 5%. And that really can be a useful starting point for assessing future potential returns. So today, the yield to worst of the Bloomberg US Aggregate Bond Index is a bit lower. It's about 4.4%, but that's still above inflation and fairly solid. And I think the good news is that there are many other areas of the bond market that have modestly higher yields that actually can help boost overall bond returns for portfolios. So for example, you can put in this category as investment grade corporate credit, high yield bonds. They're really supported by the health of businesses, and leaning into some of those areas could actually help boost returns. And at the very least, it diversifies from just investing in US Treasuries, for example. And the fact that corporate America has remained healthy has provided that support for investment grade corporate bonds and high yield bonds this year, and that may persist into next year. Now, given all this bond backdrop here that I've talked about, bond positioning for portfolios that we manage certainly remains well diversified. There's ample exposure to higher quality bonds like US Treasuries. They, in our view, can really act as portfolio shock absorbers when markets are a little bit more volatile. But there are many other types that we're trying to layer in there, like mortgages, those higher rated corporate bonds, high yield bonds, non-US bonds, and they can act as return diversifiers. So the outlook, it remains solid, but I think diversification, again, even within bonds here, plays a vital role.
Well, thank you. Let's switch gears a little bit. I'll keep you on the hot seat though. So another sector we get tons of client questions about, and what you referenced earlier is AI. So let me ask you point blank, is it a bubble?
Yeah, I get it. I mean, particularly given some very strong returns from companies associated with AI development, as well as the news of significant investments being made on data centers. I noted some of those numbers earlier. Frankly, it's a question that we could probably discuss for this entire webinar. it is a massive question that investors are battling today. But I'll just try to be brief in the context of today's events. So historically, overinvestment in new innovations and technologies has sometimes led to downturns, but we may not be near that point at this time. Because in the meantime, there are still high levels of AI spending, and it has been a significant factor in stock returns, and it could be going forward. Now, there are many different views on this topic, and one common one that seems to keep coming up is this parallel between today and the late 1990s dot-com era. There was a period where we had very high valuations, but also a lack of corporate earnings. And all of that began to unfold and led to a downturn in the market in the early 2000s. So I'm bringing up one last visual to bring this to home today. And it's really a comparison of today's tech sector with the late 90s to early 2000s peak in the internet or dot-com era. And if we take a really closer look on this, we can kind of see how they're differentiated. On the left-hand side, we're showing valuations or PE ratios of the US tech sector. The tech sector today has price to earnings ratios that are much less than the peak during the internet boom in 2000. Now, the right-hand side of this chart, it's showing the earnings growth of the tech sector. And here you can really see a distinct difference. So you'll see positive earnings growth today, but it was negative at the peak of the internet rally. So it really kind of shows that it's not exactly the same setup as that late 90s, early 2000s period. So look, this is the present landscape. It's likely to change over time, and we need to keep a close eye on it. But so perhaps if I just make this all a little bit simpler, it's just to say that markets are likely in an AI boom, and it's being driven by the significant business spending, and trying to boom time when booms turn into bubbles or even busts. That's very tricky business. And it reminds me of this investing adage. It's quote something like, the hardest part of riding a bull market is staying on. So investors that are too early in dramatically reducing stock exposures because of this natural fear of potential future loss, they actually may be leaving meaningful returns on the table. And that's why within diversified client portfolios that we manage, the investment team really is continuing to cautiously participate. We recognize the rising debt levels to finance this AI build out. We recognize the lofty expectations, but we also continue to see significant AI compute demand and no imminent slowdown in business spending related to it. So therefore, we're maintaining healthy allocations to US stocks, but actively managing risk. And that includes those modest tilts to non-US stocks that can help diversify away from the technology concentration sector risk that we're seeing in US stocks. And when within the US stock portion of the portfolios, we've sought to actually leverage different investment strategy approaches. So that means leaning into some value in small cap stocks. That can also help diversify beyond just the largest AI focused companies.
Well, let's keep talking about high valuations here. You know, gold prices have surged this year. Investor uncertainty has traditionally driven interest in gold and other precious metals. So do you see this as an important diversifier for portfolios?
Potentially. So look, every investment decision really should be framed around an objective. And just because a security or investment has posted strong returns doesn't mean it warrants an investment for everybody. Now, that being stated, I think for longer term focused portfolios, some exposure to gold and other precious metals can serve as a diversifier. Historically, they can provide some hedge against higher inflation, but they also provide some portfolio support during periods of high economic policy uncertainty. That's something certainly we've seen in recent history. There are a number of ways that I think investors can gain exposure to gold and other precious metals. There are specific exchange traded funds or ETFs, as well as it's usually found in diversified commodities funds. Some investors actually even prefer to invest in gold and precious metals mining companies. So those are stocks. They might provide compound earnings growth over time. I think with all these approaches, I might just provide a little caution, and that's this notion that a little investment exposure can go a long way in this space. In other words, there are periods when gold and other commodities can differ, sometimes significantly, from traditional stocks and bonds. And then there's one last point. It's related to taxes. In taxable accounts, so think trusts and brokerage accounts, various gold investments are taxed as collectibles. So that often means that it's a higher tax rate than the traditional long-term capital gains tax rates for taxable accounts.
Taxes are certainly on the minds of our clients. Relatedly, and we'll shift topics a little bit to some more planning strategies. So as many of our viewers are aware, the deadline for taking your RMD each year is in a few weeks on December 31st. So what about for clients who are concerned about taxes on their current or future RMDs? Lauren, can you help us here?
Yes, so taxes on required minimum distributions can be a significant concern, especially as account balances continue to grow. Now, there are some strategies that can be considered to help manage current and future RMD impacts. Now, these are just some ideas, but please do speak with a tax advisor about your individual circumstances. There are 4 different strategies I'm going to cover here. The first one is qualified charitable distributions, and you may have heard of the term QCDs. And if you are 70 and a half or older, you can donate up to $108,000 directly from your IRA to a qualified charity. When you take the withdrawal from the IRA, it does not count as taxable income. So if you are already of RMD age, the QCD will go towards your required minimum distribution. And again, this does not add taxable income. The second strategy is Roth conversions, where you're ultimately converting pre-tax dollars from traditional and rollover IRAs to a Roth IRA before required minimum distribution age, which currently is set at 73. And this will ultimately reduce future RMDs. Now, Roth IRAs don't have any RMDs, and qualified withdrawals are tax-free. This strategy can be best utilized in lower income years. Another option is just strategic withdrawals before required minimum distribution age. So you take voluntary withdrawals from the IRA to spread out the taxable income. Now, this does help avoid larger RMDs later that could push you into a higher tax bracket. Some of my clients will utilize these assets to cover their living expenses. Some will pay the taxes and then turn around and reinvest it in a taxable account. So again, can be handled very differently depending on each client's situation. And then lastly is asset location. And I think Lars is going to touch on this shortly, so I don't want to steal his thunder. But holding tax inefficient assets like bonds in tax deferred accounts like IRAs can also help with tax management, both current and future.
All right. Well, speaking of taxes, Lars, we know Strategic Advisors takes a tax smart approach to managing client accounts year round. So with year end approaching and our webinar also ending soon, what are some quick strategies that investors can consider?
Yeah, you're right. We do it all year long, which is this various tax smart moves to, and that's because taxes do take a meaningful bite out of investment returns. So it's something that we try to do throughout the entire year, not just year end. But to your question, for our clients today and listening, what are some of the things that you might be able to keep attention on at year end related to different tax smart investment strategies or techniques? I think the one that comes to mind that is the most powerful for thinking about the impact of taxes is something called tax loss harvesting. It involves selling investments or specific tax lots that have actually declined in value. An investor can actually use those tax losses to offset future gains. So if you are managing your own accounts today, it's worth looking through all of your holdings and your tax lots just to assess if there are any potential tax losses that may help offset those realized taxable gains during the year. Another strategy, and Lauren brought this up, is that notion of asset location. This involves placing different types of investments and different types of account registrations based on their tax efficiency. For example, it may make sense to shift more taxable bonds to tax deferred accounts like IRAs. And that's because bonds are more tax inefficient because they're kicking off all this this regularly interest income, and that's generally taxed at higher income tax rates in the year earned. One last one that I'll point out, besides tax loss harvesting and asset location to be aware of, is those charitable endeavors. I think listeners today might consider just donating certain appreciated securities. After several years of some strong returns, they may be out there. That can really help actually manage some of the concentration of investments that have done well, while also potentially reducing the future tax impact of selling those investments at a capital gain. So those are just three. There are many more different tax smart strategies that you can employ, and I think it can all feel pretty complicated after a while. So I would just invite listeners today to review our various tax smart investment techniques. They're available to you, and maybe talk with a Fidelity representative, and they can see how it can be more personalized for your specific situation.
Great, Lars. And Lauren, as we wrap up, what else should clients keep in mind as year-end approaches? Maybe a few quick key takeaways there.
Absolutely. So there are two ways I want to address this question. The first is, what else can we be doing before year end? And the second is more reflecting on certain items as the year ends and a new year begins. So a couple items to look at before year end is, first off, make sure we've maximized our savings. This could be 401k contributions. It could be IRA contributions. We have health savings accounts for those on a high deductible plan that would be eligible. And then just a couple items that we've already covered, but as a recap, we have gifting, and this includes both charitable giving as well as the annual gift exclusion of $19,000 per recipient. And then we have the tax management, Roth conversions, tax loss harvesting, and managing capital gains, as well as prepaying any deductible expenses if you are itemizing taxes for 2025. This is also a great time for some housekeeping items like reviewing beneficiaries on accounts, revisiting insurance policies to ensure limits and coverage are still appropriate. This could be home, auto, health, long-term care. And then to pivot to my second answer, whether it be in December or January, I encourage my clients to reflect on the past 12 months and really evaluate what worked or didn't work, and then create a game plan for changes to implement for the next 12 months. And in fact, and very timely, you can join us again for Insights Live on January 15th, when we specifically talk about getting your financial plan on track, maintaining and developing your investment strategy, and evaluating your savings goals.
All right. Well, thank you, Lauren. And thank you, Lars. I want to thank you both for such great insights on this topic. Let me hit on a few key takeaways really quickly. So despite some slowing areas of the economy, the U.S. remains in expansion. Lars talked about this, and corporate profits have continued to grow. So we don't see an imminent recession and believe conditions are in place to support U.S. stocks. I think Lauren hit on this multiple times. Diversification matters, and it helps you benefit from potential growth over time while managing risk. And then lastly, work with a financial professional. They can help build a personalized financial plan and help you develop an asset allocation that's appropriate for your risk tolerance goals and time frame. So we hope you, our viewers, will join us for our next Insights Live webinar on January 15th. We'll be discussing strategies for setting financial goals. And in the meantime, please reach out to your Fidelity representative to have your specific questions answered. As we close out 2025, on behalf of our team here at Fidelity, we wish you and your loved ones a wonderful holiday season.
Yes, I second that. Best holidays and a happy and healthy new year.
Yes, happy holidays, happy new year.
All right, thank you again for joining us.